Hi, I'm Devang Shah. I'm here to present to you the monthly fixed income outlook. Today we are going to cover first the summary of macro events for the month, secondly the impact of that on the market, thirdly the strategy of the portfolio and the outlook for the market, and lastly, most importantly, what investors should do in such a market environment. To start with, the month started with the RBI policy announcements, which was status quo on rates. There were no changes in economic projections for the year, and RBI continued to remain cautious on its inflation outlook. If you look at the data points, the March CPI data point eased to 485. It was a 10-month low on CPI, and it was significantly lower than the Feb CPI also. Core CPI eases to 3.3. If you look across at data points in US CPI came in at 3.5% in March. It was up 0.3% from February. Again, monthly inflation came higher, slightly above expectation. Other US macro releases like retail sales, employment data, all came a bit stronger than expected. Come back to India again and you look at the banking liquidity scenario. The banking liquidity scenario remained close to neutral, and overnight rates for most part of April were closer to the repo rate of 6.5%. Commodities saw a significant uptick in prices, specifically crude and precious metals, due to the rising geopolitical risk. The impact of all this on our markets, the stronger than expected US data and the rising geopolitical uncertainties led to a sharp rise in US Treasury yields, both short and long term. We actually saw a 40 bips rise in yields for the month, which led to rise in bond market yields in India too. We saw a 10 to 15 basis up movement for long government corporate bonds and even the swap markets. Both US and Indian markets now don't price in any rate cuts for the next 12 months. And we need to look at it from a perspective where at the beginning of the year, they were pricing in 5 to 6 rate cuts. And now they're pricing in nil. US markets are pricing in less than 1, and Indian markets are not pricing in any rate cuts for the next 12 months. It is important to assess that there has also been a shift in operative rate from 675 to 6.5. That's due to increase in banking liquidity, and that has led to the rally in short-term bond yields. Money market yields up to 1 year and corporate bond, specifically SDLs, saw some compression for the month due to lesser issuance for the month. The strategy which we adopted for the portfolios and the outlook for the market, in lieu of these rising geopolitical risks, the run-up in crude prices, stronger US data, we believe that fundamental macros have taken a backseat in the near term. And central banks across, including RBI, would not be in a hurry to cut rates. The core view continues to remain constructive on rates, and that's due to the positive demand supply dynamics, specifically for Indian IJBs, and due to inclusion of our bonds in JP Morgan Bloomberg indices. Our core portfolio strategy continues to remain long, but we have remained cautious and maintained some higher allocations to corporate bonds and SDLs due to lower issuance and perceived change in RBI liquidity stance. What should investors do at this point of time? I repeat, investors may use the rise in yields to build in both duration across their portfolios and increase their allocation to fixed income. Investors, though, need to be patient as rate cuts would be delayed to the second half of financial year 25. With positive demand supply outlook for bonds, improved liquidity stance of RBI, we continue to advise short to medium term funds with tactical allocation to gilt funds to our clients. However, the investors should consider the risk appetite before investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.